All right, y'all, welcome back to Principles of Accounting 1. Wow, we are making amazing progress. It's November the 20th, 2025, which means we are making very quick progress in the course in the semester. And as we can see, we're currently sitting in week 13, which means we only have two remaining weeks after this week, and we're already on Thursday. Yeah, so uh, it goes by so quick. So today we're going to talk about corporations, and we're going to talk about stocks and bonds, and how corporations raise money, how they pay dividends, and we'll talk about interest a little bit more. And that'll be our conversation for today, for accounting for corporations. And then we will we will then next week talk about long-term liabilities. Nice, easy conversation next week, talking about loans and things like that. And then we'll wrap up the semester talking about investments and the statement of cash flows. Also, relatively shorter discussions. So we do have some busyness in front of us. So just wanted to call your attention to the classroom. Here we are in week 13. And the work that we have for this week is the 13 quiz. Um, Next week we will have the 14 quiz, and then I think in 15 I think there's something else going on. So uh, I would recommend that if you have some extra time to try to work ahead because it'll just make things a little easier for you. So let's go ahead and jump into today's conversation on corporation accounting. And the thing you really need to know about corporate accounting is how stocks are distributed, how we account for stocks and bonds. We'll also talk about retained earnings and how those come into play. Um, But overall, the biggest takeaway I want you to have from tonight's discussion on accounting for corporations is really how we work with stocks, how we work with bonds, how we account for dividends. Um, and I'm going to walk you through the process. It's pretty straightforward overall. There's no, nothing really tricky going on here. The math that's involved this evening is also pretty straightforward. So Um, as always, if you have any questions about our conversation tonight, just feel free to unmute your microphone and ask your question, or feel free to type it in the chat, and I'll be happy to answer it for you. So let's go ahead and jump into it. Uh, the first thing I'd like to talk about is what a corporation is and how it's organized. Because as you already know, there's a couple of different forms of business. The most common is of course a sole proprietorship, which is one person who owns the business. The second most common is a partnership, two or more individuals. Um, and then the third is a corporation. So we're going to talk about corporations of how they're formed, why they're organized the way that they are, and how we identify who the owners are. So a corporation. Really best way to think about a corporation is that it is its own legal entity. It's separate from the owners. Okay. The corporation kind of acts as its own person. So the way to think about a corporation is that the corporation is responsible for their own income, responsible for paying their own taxes, um, and it's separate from the owners. The owners of a corporation are typically called shareholders or stockholders, and these individuals uh, can own shares in a private or public business. Okay. Uh, the corporation, again, is its own entity. It pays its own taxes. It generates its own income, separate from the owners, and it has its own rights. Okay, so the way to think of a business that's a corporation is that it's kind of like its own person. And the corporation can either be public or private. Private means that it's held within the owners. It's not the shares of stock are not available for individuals like you and I to purchase. Public corporations are the corporations that are traded on the public stock exchanges. Like for example, Starbucks is a publicly traded corporation. Uh, so probably some of obviously the larger names are publicly traded like Nvidia, Apple, Samsung, you name it. All of the big names that you hear about frequently, the majority of them are publicly traded, and you'll be able to buy and sell shares of stock on the public exchange, which makes them a public company. So those are really the differences between private and public. Private is closed off, so there's no public ownership. And public, there's usually a ton of stock involved, and there's a lot of different owners. So, and we're going to talk more about that here briefly. So, why form a corporation instead of a different type of entity? Well, there's some really great advantages here. One is that it's a separate legal entity, meaning that if the corporation gets sued, it's the company that gets sued, not the individual owners, right? Which is great. There's to that point, there's limited liability, meaning the individual stockholders are not liable for the corporate debt. Uh, there's transferability when it comes to ownership rights. So individuals can buy and sell shares of stock in the business without any recourse. So that's pretty awesome. We're able to buy and sell shares of stock as we see fit, which represents the transfer of ownership rights. Corporations are continuous, meaning that even if the owner dies or passes away, the business will live on, regardless of who owns it. There is no mutual agency for shareholders, which means that the individuals that hold shares of stock are not legally bound to the corporation through contracts. So, in other words, there's no mutual agency. And it's also really easy for the company to be able to raise funds. And the way that a business can raise funds or cash is by either selling shares of stock, which is equity, or the company could take out loans through the bank, which is debt. So debt and equity financing are really the two primary ways for a business to get started, and also to continue operating into the future. So as you may recall, there's a ratio that we calculate. It's called the debt to equity ratio, and every company is financed through equity and debt. Yeah. And so on the equity side of things for a corporation, it's represented in the shares of stock that have been issued to shareholders. We call that shares of stock outstanding. And the there's really two primary disadvantages to forming a corporation. One is that there's a lot of government regulation, especially for publicly traded companies, because they have to follow regulatory rules and regulations with respect to issuing shares of stock. And the second disadvantage, which is always a disadvantage, is the taxation, right? So corporate taxation in t taxes could be 21% or more in some cases, depending on the amount that the corporation generates. So the corporate tax rate in America is anywhere between 18% all the way up to 40% depending on the corporation, which is pretty excessive. But at the same time, everyone has to pay their fair share of tax, right? So corporations are taxed separately than the individuals. So that's kind of a disadvantage. In other words, there's no pass through when it comes to taxation. This slide here, this is a typical organization chart of a corporation. You'll notice that at the very top of the organization chart is the shareholders. The corporation is that drives the organization are the shareholders. Um, the shareholders elect the board of directors. The board of directors elect the president of the company and the vice presidents and the other officers, and then those officers hire the employees. So, um, this is your typical organization structure of a corporation. We all answer to the shareholders when you work for a corporation. A couple of cool things about being a shareholder is that you have a right to vote in any registered meeting. You have a right to sell your stock. You have a right to purchase additional shares of stock. You have a right to receive dividend payments if the corporation decides to issue any. You also have the right in any assets remaining in after creditors are paid in a liquidation of the company. So very, very great rights to shareholders. I personally am a shareholder of a couple of companies. Most notably, I have several shares of stock in Starbucks. Um, I can purchase and sell my shares. For a gain, which is what a lot of people do. They'll purchase shares of stock at lower prices, sell them at higher prices, obviously to gain a profit. Super, super common. If any of you have retirement accounts, within your retirement accounts, you might have mutual funds. A mutual fund is simply a portfolio of a lot of different stocks. Okay. Um, and because you have that mutual fund, you own shares of stock and you have the right to vote when any of those companies in that portfolio have elections. So just cool things to know. But as a shareholder, I try to exercise my rights whenever possible. So what is a share of stock? It represents a share of ownership in the business. So if you have a share of stock in, let's say, Starbucks, you're technically a part owner of Starbucks. Okay. So it's up to the value of the stock, of course, but you're technically an owner of the company when you own a share of stock in the company. That's what stock represents. It represents shares of ownership. Here on the slide, we see a share of stock uh, in a football organization that is publicly traded, Green Bay Packers. Um, Now, you'll notice that it's printed on actual stock paper. That's where the name came from. Back, well before we had computers, we would print the shares of stock um, on actual stock paper, right? That's where the name stock came from. And it shows the serial number. It shows the par value of the share of stock. It shows uh, what it's for, when it was issued, who it was issued to. So having a share of stock, super, super cool, uh, because it represents your share of ownership in the company. These days, the companies don't really print these anymore. You end up getting a digital one in your email. So, uh, a couple of definitions you need to be aware of. First is called capital stock. Capital stock is a phrase that we use when it comes to shares that are issued and obtainable. Uh, call that capital stock. We have authorized stock, which is the number of shares that the company is allowed to sell. So authorized stock is the shares of the company that the company is allowed to sell. And this number is typically dictated in the company charter. The company issues shares of stock. We call these uh, uh, stock issuance. When a company is able to sell shares of stock, they issue those shares of stock, meaning that they can be bought directly by individuals. They're available for sale when they're issued. The shares of stock are issued at what we call market value. So when you purchase a share of stock on the stock exchange, you're purchasing it at its market value. It's what it's worth today in the open market. Uh, and when you do purchase a share of stock, that share of stock goes from being issued to outstanding. Outstanding means that the share of stock is being held by a shareholder, right? We call it outstanding because it's outside of the company at that point. It's being held outside, outstanding of the company by a shareholder. That's what we call it, outstanding. And these stocks have a characteristic of being called common stock or preferred stock. Common stock are shares of stock that are held by the common people, common shares of stock. Preferred stock are shares that are typically held for employees of the company. Uh, and it has a different stated value. We're going to talk about these stated values here in a second. So each share of stock that the company issues or authorizes has what we call a par value. The par value is a stated value that is assigned by the company to give it some minimum legal amount. Okay? It establishes a minimum legal amount. Typically, a share of stock has a par value of 1 penny. So 0.01, or sometimes a fraction of a penny, 0.001 will be the company's par value for each share of stock that it issues. The reason why is to give each share of stock some form of legal capital. So that's why par value exists. It's to give each share of stock some value. And because this is an assigned value by the company, it's typically a very, very low amount, like 1 penny. Yep. It's important to know that the par value of a share of stock is never the same as its market value. The market value represents the price of the share of stock that can be bought or sold at in the open market on the exchange. Okay. So oftentimes if you look at like the newspaper newspaper, or if you look at watch the news, or you know have whatever, you'll see sometimes a ticker symbol for your company, and it'll have the stock price right next to it. Whatever that price is the value, market value of that share of stock at what it's trading at that time. It's also important to note that there are some instances where a share of stock will have no par value. A no par value stock means that there was no value assigned to it through its company charter. Um, so it can be issued at any price without any legal minimum. Um, these are relatively rare, but there are some instances where there's no par value stock. And the other thing you need to know is that the definition for stated value stock, which is no par stock, which there is no stated value per share. Again, relatively rare, but just something you need to know. So let's talk about how these shares of stock are accounted for the company. On the balance sheet, you know that we have a list of all of our asset accounts, liability accounts, and equity accounts. On the equity side, this represents what the owners of the company own. And this is where the stock lives. Okay. Um, and it includes, a couple of things. It includes an account we call paid in capital, which is the cash that the company received in exchange for the stock, and uh, the number of shares outstanding. The paid in capital account is typically in excess of the par value. For example, let's say a share of Starbucks stock is $10 per share and it has a par value of $1. Remember, the par value is the minimum acceptable value that we can place in a share of stock. So if it's currently selling at a market price of $10 per share and has a par value of $1, that means that it's selling $9 above its par value. And so that $9 would be reflected in an account called paid in excess of par. And then the $1 would be recognized at its par value. So a debit cash, $10, credit par value, $1, and credit paid in capital in excess of par, $9. So that's what that type of transaction would look like. As you also know, under your equity accounts on the balance sheet, there's an account called retained earnings. Retained earnings is net income minus any dividends that have been paid out. So net income minus any dividends, that's your retained earnings. It's what's retained in the business, what's kept in the business. So that's everything that stockholders' equity is made out of. And when you look at a typical balance sheet, you'll see those types of accounts listed on there. So let's talk about uh, this concept of how we record the stock. We're going to roll through a couple of examples. That's also kind of timely with a snowboard company, right? All right. Hopefully not yet. I mean, it's cold out, but hopefully not cold enough to snow. Uh, Here we have an example where the company is just getting started and they're trying to raise funds, right? The company needs to raise capital in order to operate the business. And as I mentioned earlier, there's two ways that a company raises capital. One is by issuing shares of stock, what's called equity, and the other is taking out loans, which is debt. So debt and equity financing are the two ways that businesses raise funds. So here we have an example of the company just getting started, and they decided to sell or issue 30,000 shares of the company's stock, and they decided to issue those shares of stock exactly at their par value, which in this case is $10 per share, par value. So, so we sold 30,000 shares at $10 par value per share. So we debit cash 300,000 and we credit common stock at par value 300,000. Now, ideally, the company should be selling shares of stock above its par value. So, uh, because the company needs to be able to raise cash, and so selling at par value just really isn't that ideal. So we try to sell it above par value, which we call in excess of par or at a premium. We sell it at a premium when it's above par value, at a discount if it's below par value, or it's just simply at par value. So here we have an example where we're selling it above par value. So we issue 30,000 shares of stock that has a $10 par value. We sell it at $12 per share. Excellent. So in this case, the difference is paid in excess of par value, which is 60,000. How did we figure out that it was 60,000? We take the issuing price, $12, minus the par value, $10. That's $2 per share times 30,000 shares. That's $60,000. So in this case, we debit cash $360,000 that the company is receiving. We credit the common stock at its par value, $10 per share, 30,000 shares. That's 300,000. And we credit the paid in capital in excess of par at 60,000. Now, at the end of the year, once we're all done here, we have to close out our temporary accounts, and in that process, one of those things that we do close out is our paid in capital accounts. We close those out to retained earnings, and the way that we do that is through this process here. So we take our common stock plus our paid in capital uh, uh, plus the retained earnings gives us total shareholders' equity. So sometimes a company might issue non-par value stock. With non-par value stock, there would not be any entry to paid in capital in excess or at a discount because there's no par value. There's nothing to compare it to. So in this case, we would just simply debit the cash and credit common stock at non-par value. So here we have an example. We sold or issued 1,000 shares of non-par stock at $40 per share. So that's of course $40,000. So we debit cash 40,000, credit common stock non-par value 40,000. Here we have an example where we do have a stated value of common stock. With a stated value, the difference between the stated value and the sale price, we would credit paid in capital in excess of the stated value. So here we have the same examples, 1,000 shares at $40 per share. That has a stated value of $40 per share. We issued at $50 per share. So of course that's 50,000. So we debit cash $50,000. We credit common stock at its stated value of $40 per share, $40 per share, which is 40,000. And that we credit the difference, which is paid in capital in excess of stated value, by 10,000. Next, we have issuing for stock for non-cash assets. Sometimes when a business just gets started, we don't have a whole lot of cash on hand. I can't afford to be shoveling out all this cash for, things like land or buildings or, maybe even some really high bills. And so instead of cash, I might make a deal if I need to purchase something that's real big. And the deal will work something like this. Say, hey, listen, I'd love to buy that piece of land from you, but I can't afford $105,000 in cash. Company's just getting started. I don't have that kind of cash on hand. So we make a deal. And the deal goes something like this. Hey, listen, instead of paying you 105,000, instead I will be happy to issue you 4,000 shares of stock. And that'll be the exchange. I'll give you 4,000 shares of stock instead of paying you the 105,000 for the land. Now, these shares of stock, they only have a $20 par value. So 4,000 times the 20, that's 80,000. The difference is going to be the paid in capital in excess of par value. So we debit the land, 105,000. We credit the common stock par value, 80,000. The difference is a paid capital in excess of par, 25,000. So this is an example where we see that there was no cash involved. It was just simply an exchange for shares of common stock rather than paying out cash for an asset. We can also issue shares of stock if we don't have enough cash on hand for other things, like organization expenses, which are legal fees, right? It's like, oh, got this real expensive attorney, took care of incorporating my company, but I can't afford to pay him, so I'll pay him in shares of stock instead. So, and that's exactly what we did here. So here we said, hey, attorney, we'll give you 600 shares of stock in the company. It has a par value of $15 per share for the $12,000 of work that you performed. So we would debit the legal fee or organization expense, 12,000 bucks. We credit common stock, $15 par value, 9,000. So 15 bucks times the 600 shares is 9,000. The difference, of course, is the paid in the capital in excess of par value. So we would credit 3,000 there. So this again goes to show you that we don't always need cash for everything, but it certainly helps. Instead of paying them in cash, you can pay them in stock. All right. Now, sometimes you might get lucky and have a share of stock in a company that pays dividends. Well, lucky you. I will tell you that Starbucks has not paid me any dividends in a long time. I think the last dividend check I got from them was like 50 cents, and that was a long time ago. Sometimes they pay dividends to their shareholders, which, in my opinion, is a great way to treat their investors, and it's a great way to attract new investors. So that's why some companies do still pay dividends. Now, sometimes they'll pay that dividend in cash. Sometimes they'll pay that dividend in additional stock, which we call stock dividends. And sometimes there might be what we call a stock split. And I'm going to explain all of these to you. So cash dividends, it's great when the board of directors decides, hey, we're going to pay cash dividends to our stockholders. There's a couple of things that happen when they make that decision. The board of directors meets, they decide to declare a dividend. They record the number of shareholders at that time, and then they have a separate date where they pay out off the dividend. So great, it's awesome for when shareholder receives dividends. But of course, the company needs to make sure that before they pay a dividend out, they have enough in their retained earnings account. And obviously, they need to make sure they have enough cash on hand to pay the dividend. So, pretty obvious things, but got to make sure you got those two things going on for you before you pay out. So, as I'd mentioned, board of directors gets together. They decide to declare a dividend, so that we call it the date of declaration. So, with that date of declaration, we debit retained earnings and we credit dividend payable uh, based off of the cash dividend that they plan to pay per share of stock times the number of shares of stock outstanding. Call it date of declaration. The second date to be aware of is called the date of record. This is where we identify all of our shareholders, identify who's going to receive the dividend. There's no journal entry required there, but it's just important to note that this is the date that we cut off and say, hey, this is the number of people that have shares of stock. This is who's going to receive the cash dividend. And then, of course, the date of payment. Date of payment is very simple. We debit common shares of stock dividend payable, and we credit cash. Yep. So let me roll through a couple of examples with you on this. Here we have a tech company. They decided they declared a dividend. So on the date that they declared the dividend, they debit retained earnings and credit common stock dividend payable. In this case, it's for $5,000 at $1 per share. So each share that you own, you'll receive $1 for as a form of a dividend payment. So kind of nice. So they debit retained earnings, credit common stock dividend payable on the date of declaration. Then on the date of record, they don't record any type of journal entry because it's just a matter of identifying the shareholders that will receive a dividend. And then when they do decide to pay the dividend, they debit common stock dividend payable and they credit cash. So very simple process, but just want to make sure you understood how that works. The next thing I want to talk about is called the stock dividend. Stock dividend is instead of the shareholder receiving cash as a form of payment for stock ownership, the company will decide to give additional shares of stock to the existing shareholders. Call it a stock dividend. Now, the reason why this is an attractive option for companies is because there's no cash involved. They don't have to worry about shoveling out a bunch of cash for a dividend. Um, and it stabilizes the stock price to some extent. If it's a small stock dividend, they distribute less than 25% of previously outstanding shares. If it's a large stock dividend, it's greater than 25%. So let me walk you through this process of issuing a stock dividend. So here we have an example. The company has 10,000 shares of $10 par value stock outstanding. The company decided to declare a 10% stock dividend when the stock was selling at about $15 per share. And it will be distributed to owners on January 20. So the journal entry that we make at the end of the year for this uh, is first to retained earnings. So we got to figure out how much for retained earnings. We take the 10,000 shares, we multiply that by the 10 uh, times the 10% stock dividend. That's 1,000. So 1,000 shares at $15 per share is $15,000. So we debit retained earnings $15,000. We credit common stock dividend distributable, just common stock dividend distributable or payable 10,000, which is the par value. So 1,000 shares at $10 par value. And the remainder is paid in excess of par value, 5,000. I want to show you what this looks like because how it's eventually paid out. So we made the recording, debited retained earnings, credited common stock dividend distributable or payable, and credit paid in capital in excess of par. Uh, and just to show you what it looks like before the stock dividend, we had a total stockholders' equity of 143,000. When we made the declaration, we added in 10,000 shares to the stock distributable. We added in 5,000 paid in excess of par, and we subtracted out 15,000 from retained earnings, which gets us a net zero. When we distribute the 10,000 par value, we have a debit to the common stock and a credit to the common stock dividend distributable. And so what this does is it shows us how the stock dividend is distributed, yeah, and what the effect is on the accounts. You'll notice that total stockholders' equity does not change at all when it comes to non-cash dividend. So here, I'm going to show you the difference between a small stock dividend and a large stock dividend. It's real simple. It's just based off of the percentage, right? So anything less than 25% we consider a small stock dividend. Anything greater than 25% we consider a large stock dividend. So here we have the same example from before, 10,000 shares, $10 par value. 10% stock dividend was declared. And so we debit common stock dividend distributable 10,000 and we credit common stock $10 par value 10,000. Very simple. Now, what if that percentage was, let's say, 30%? So 30% would put it into a large stock dividend. So really the only difference here is the percentage. So we treat this the same exact way as we do with a small stock dividend. So 10,000 shares, dollar par value, stock outstanding, declared at 30% dividend. So we take the 10,000 shares times the 30%, that's 3,000 shares at $10 par value. Yeah, I think that was supposed to be a 10, not a 1. $10 par value uh, equals $30,000 of common stock that will be distributed. So we debit retained earnings 30,000 and credit common stock dividend distributable 30,000. The next thing about stocks I want to talk to you about is with a stock split. This happened to me one time with Starbucks. Uh, just give you a real quick and easy example of this. I used to have, let's say 20,000 shares of Starbucks stock, and it was worth maybe, 50 cents a share. So 50 cents a share, I had 20,000 shares. That's about $10,000 worth. The company said, "Oh, we're going to issue a stock split." So all that means is that they're taking each share of stock that you have and splitting it into two. Okay, stock split, splitting it in half, or by some ratio if they decide to do it more than a 2-for-1. So, um, in my example, it was 2-for-1. So 50 cents a share, 20,000 shares is what I had. So it was 10,000 bucks worth. So they said, "Hey, we're going to do a stock split." So I was like, "Okay, that's cool." So they gave me 40,000 shares of stock. I originally had 20. They split each share. So now I have 40,000 shares. Now remember, they were worth 50 cents a share, but when the stock split, they became worth 25 cents a share. So there's still the total value did not change. It was still $10,000 worth. I just happened to have double the number of shares, right? That's what a stock split is. It's splitting the stock into two. That also implies that they split the value into two. So here we have an example on the slide. We started with 100,000 shares at $20 per share par value. They split that into two, which means that we now have 200,000 shares at $10 per share. Right? The total value is the same. It's just we have a greater number of shares. The good thing about stock splits is that it gives you that additional stock to be able to sell or to retain, which is great because as the market value goes up, ultimately that means you'll do better because you have more shares of stock to be able to sell. So that's really the benefit behind it. The negative part behind it is, God forbid, the price goes down. You know, and the other thing is it kind of dilutes the shares of stock. So let me show you the comparison between the types of stock dividends that we've seen. So cash dividends, small stock dividend, large stock dividend, and stock splits. The cash dividends, these have the biggest impact on the financial statements. Obviously, we're paying out cash, so we decrease total assets. There's a decrease to the total equity because once again, we're paying out from the equity account or the retained earnings account. Um, and there's your retained earnings account. Obviously, that's going down because we're paying the cash out of there. For the small stock dividend, uh, not a whole lot of changes, except obviously in the stock itself. So there's an increase to common shares of stock. There is an increase to paid in excess of par, and then there's a slight decrease in retained earnings um, to match, and then so therefore there's a net zero change for small and large stock dividends. For the large stock dividend, there's an increase in the shares of common stock and a decrease by the same amount in retained earnings. And then with stock splits, there's no changes at all. It's just the number of shares outstanding increases by that same amount, but there's no other change other than that. So it's just a nice side by side comparison. Next, I'd like to briefly talk about the difference between preferred stock and common stock, and how that works. With preferred stock has special rights, so these are given priority status over common stock. These shares of stock are typically reserved for employees of the company, um, and which include things like, um, stock benefits to employees. Yeah, we call these preferred stock. So here we have an example. A company issues 50 shares of $100 par value preferred stock for a total of $6,000 in cash. So a company is going to receive the $6,000 in cash. The par value is $100 per share. At 50 shares, it's 5,000. The difference is paid in excess of par for preferred stock, 1,000 bucks. And then we close that out through retained earnings to our total stockholders' equity, just like we did before. So the reason why companies would issue preferred stock over common stock is to raise money without sacrificing any type of control, because there's no voting when it comes to preferred shares. It's great for employees because of the company as a performance package, gives them more incentive within the company. Uh, it does boost their returns, which is excellent for them. And this is very appealing for new investors. So so relatively low risk, but also somewhat of a low reward. Now, when it comes to the preferred stock can be identified as either what we call cumulative or non-cumulative. When something is cumulative, it means like it accumulates in value over time, right? So that's what accumulation is. This is where dividends can be paid in arrears before any common shareholders receive dividends. Uh, once again, preferred stock is over common stock. Or the preferred stock could be considered what we call non-cumulative. This has no prior periods, and so if there were any unpaid dividends, those simply get ignored. So let me show you the how this works in practice. So on the left side, we see cumulative preferred stock, and on the right side, we see non-cumulative preferred stock. When it comes to cumulative preferred stock, any dividends from prior years get paid out first to preferred shareholders. So year one, there was 5,000. Year two, there was 13,000. So at the end of year two, we're going to pay out both years one and year two. Whereas common shareholders, they just get whatever's left. Yeah. For non-cumulative, they will receive the year one amount and year two amount. That's it. They don't receive any prior dividends. And then common shareholders, they receive the rest, just like before. So it's just good to know. Not super critical, but good to know stuff. Sometimes a company will repurchase its own stock. This is a really common practice because companies want to stabilize their stock price, control how much shares of stock is outstanding, and really a great way to mitigate any risk. We call this treasury stock when a company repurchases its own shares of stock that are outstanding. So anytime that you look at a company's financial statements, if you look at the balance sheet under equity, you might see an account called treasury stock. That means that the company has engaged in repurchasing shares of their own stock to reduce the number of shares outstanding, improve the market price, and also to mitigate any risk that the company may have with respect to hostile takeovers. Um, Here's an example of a company repurchasing their own shares of stock. Company purchased 1,000 shares of their own stock from their shareholders uh, on the open market for $11.50 per share. So that's 11,500. So we debit treasury stock, 11,500, credit cash, 11,500. Now, sometimes even after the company repurchased their own shares of stock, they might turn around and sell some of that again on the exchange. So here we have an example where they're reselling the stock. So in this case, they're selling 100 shares at $11.50 a share. So we debit cash 1,150 and we credit the treasury stock 1,150. A lot of times, hopefully, the company is selling that treasury stock above what they had originally paid for it. So here we have an example of this. The company decided to resell 400 shares of its stock for $12 per share. They had originally purchased that back at $11.50 a share. So we call that difference paid in capital in excess of treasury stock. So we debit cash 4,800. We credit the treasury stock 4,600, which is the par value. And the difference, $200, is paid in capital in excess of treasury stock. Now, also, sometimes the company might decide to sell the treasury stock below what they had originally paid for it. Don't know why they would, but sometimes they could. In this case, we see that they're selling it below par value, $11.20 per share instead of the $11.50. So we call this paid in capital below par value of treasury stock. So we debit the cash 5,600. We debit paid in capital below par value treasury stock 150, and we credit the treasury stock 5,750. The 5,750, of course, representing it at its par value. So that's how we treat treasury stock. Now, the statement of retained earnings is one of the four primary financial statements that we've learned about in this class. The first financial statement you learned about is the income statement that shows your sales minus cost of goods sold equals gross profit minus your operating expenses equals operating income minus your interest and taxes equals net income. That's the income statement. You also learned about the balance sheet, which represents all of your asset accounts, liability accounts, and equity accounts. You also learned about the statement of cash flows, which represents operating, investing, and financing activities and all the cash coming into and out of the business. And now we're learning about what we call the statement of retained earnings, which represents the changes in ownership of the business. And the statement of retained earnings, as the name implies, shows us of the amount that's retained or kept within the business. So to calculate the statement of retained earnings, we take beginning balance retained earnings plus net income minus any dividends paid equals ending balance retained earnings. Very straightforward. It shows any types of changes within the ownership of the business. Okay, that's what the statement of retained earnings shows us. Here we have some adjustments that we can make to retained earnings. So prior period adjustments, we call these corrections that have been made to prior financial statements. We make these adjustments to retained earnings because we can't go back in time and change, stated financial statements. So we do make any type of correction to retained earnings. And so here we see an example of that. We have our retained earnings to the prior period, plus or minus the adjustment, equals the adjusted balance, plus the net income from this current period, minus any dividends paid, equals ending balance retained earnings. So that's the statement of retained earnings. You might also see uh, what we call a statement of stockholders' equity. This shows us the changes in stockholders' equity. Very simple type of statement. Beginning balance plus the net income, uh, plus or minus the issuance of stock, minus any treasury stock purchases, minus any dividends, equals ending balance for a statement of stockholders' equity. Again, just kind of shows you the changes of ownership with respect to stock. That's what we call the statement of stockholders' equity. Now, as a manager, it's important that we are able to identify the company's ability to issue dividends, their ability to issue shares of stock, the ability to look at the company's financial footing with respect to the market. So we calculate a couple of ratios to be able to help us to do that as a manager. We calculate the earnings per share ratio, price to earnings ratio, and the dividend yield ratios. These are all market ratios that we calculate that really help us to better understand uh, our shares of stock, their share price, where they're heading, and their stability. The first of these being the earnings per share ratio. This is also called the EPS or net income per share ratio. Tells us the amount of income earned per share of the company's stock outstanding for common stock. The basic formula looks like this. We take net income minus preferred dividends. We divide that by the weighted average common shares outstanding. So beginning balance plus ending balance divided by 2. The next ratio is called the price to earnings ratio. Uh, and what this price to earnings ratio does is it shows us uh, what the market is willing to pay for the company's current earnings, price to earnings. So we take the market price per share divided by earnings per share. And lastly, the last ratio that we calculate with respect to shares of stock is called the dividend yield. Uh, the dividend yield, what can I tell you about this? We look at the dividend yield with respect to this shares the market price per share as how or if the company is able to pay dividends. And so to do that, we take the annual cash dividends per share divided by the market price per share. That gives us what we call dividend yield. And that, my friends, actually brings us to the end of our discussion today on corporate accounting. Um, are there any comments, questions, or concerns as it relates to corporate accounting? No? Wow, so surprising. You guys are real quiet tonight. Maybe it's because it's later in the season, yeah? We're getting closer to Thanksgiving, all that stuff. Okay. So very surprising. No questions. So what I want to tell you is obviously we have our quiz as it relates to corporate accounting that's due this Sunday night, so that's only a few days from now. Next week on t this coming Tuesday, Tuesday the 25th, we will uh, blow on through long-term liabilities. It's basically loans. We're going to be talking about loans and bonds and things like that. Um, that'll be on Tuesday. And then the following week, we'll cover investments and the statement of cash flows. And that'll bring us to the end of the semester. And then we will have our final exam on December the 11th. And that'll bring us to the close of the semester. So that's what we have to look forward to. Any comments, questions, or concerns about the rest of the class? Really? Nothing at all? You guys are super quiet tonight. Okay. I mean, that's cool. Um, whatever. Okay. So y'all know what you need to do. If you ever need any help, you can always email me, you can call me, you can hang out with me during office hours, whatever. I'm here to help you, right? So let's keep pushing forward. Let's keep up the great momentum that you have right now, you know, and let's finish this out strong. So I look forward to being with all of you next Tuesday, and I look forward to your work. So thank you all again so much for your time tonight. I appreciate all of you, and I hope you have a wonderful rest of your night and a great weekend ahead. Thank you so much.
Thanks,
Thanks,
Professor.
Professor.
Thank you, Professor.
My,
Thank
my
you,
pleasure.
Professor.
Take care, y'all. Always a pleasure. Good night. Good night. Take care. Good night. Ciao for now.